Welcome to Using Ratios for Analysis, Part 2, Finance 311. When we start thinking about ratios, we're using them as tools to help us understand the business from the perspective of managing the business. What do we need to do to be successful? From looking at it as an investor or a lender. So keep that in mind, as there's always a purpose for what we're looking at. Keeping in mind that what we're looking at are ratios. Cause is why something happens. The effect is what happens as a result. So what we have is we have our causal relationship. These are the ratios that affect profits, net worth, working capital, and debt. Okay, so they cause something to happen. And then these all have an effect on the firm's liquidity, leverage, and profitability. So when we're looking at this, we want to start out with a brief review of debt management. And in the previous lecture, we talked about leverage. And that's to the extent that the firm uses debt or financial leverage, how effectively are. They want to earn more on the debt. They want to earn more by using that money than they pay for the debt. So magnifying that return on equity, leveraging it up. They can control the firm with a smaller amount of equity. They don't need all the capital to be in the form of equity. Now, capital is the long-term structure of the firm. It includes both debt and equity. Creditors, though, tend to look at equity to provide a margin of safety. So what happens if the firm has losses? How much of that will be absorbed by the shareholder before the lender has to? So these are the key things there. Okay, we want to keep this capital structure and this concept of leverage. Leverage by itself is not bad. In fact, that's what American business and worldwide business is about. How do we use other people's money to make more money? When we look at capital structure or leverage ratio, there's a couple of things that come in. There is a relationship between equity and debt. The higher, from a definitional perspective, the higher the debt compared to equity, the more leverage the firm is. Terminology of a couple of years ago that came out were firms that were highly leveraged. That means they have very little equity and they have high level of leverage. And we're talking 10 to 1, 20 to 1. We're not talking 5 to 1, but 10 to 1, 20 to 1. The question, though, becomes, does the relationship between the debt and the equity generate an appropriate return for the risk? That becomes, what is that spread, so to speak, over our cost? Is it really worth the risk? Then you still come back to how much of a cushion is there before losses would exceed equity. So as another piece of background here, a company's balance sheet includes current assets, okay, that's your cash, accounts receivable, inventory, prepaid expenses. Then there's fixed assets, property, plant, equipment, longer term horizon, and then there's non-tangible assets. These are your goodwill, patents, other intangibles. Okay, they don't have a firm value. You can't touch them, but they have value. So the question we always ask is how much of the fixed assets and non-tangibles are funded by debt, and how much is there for the remainder of running the business? Our key ratios that we use, long-term debt to equity, and that's total long-term debt to total equity. And then debt to equity is total debt divided by total equity. And then total debt, also known as debt to assets, is total debt divided by total assets. So when we're looking at this, we have a different definition. In the long-term debt to equity, we're just looking at the long-term debt. On debt to equity and total debt, we're using total. Okay? And when we look at capital, that is how the company has used it. What's the total debt divided by total debt plus total equity? So in other words, the percentage of the company that's funded by debt. Next one is how have we levered the financial assets. So we have total assets divided by total equity. So these are your key calculations that we go through. Let's take and look at these from a slightly different perspective. Okay, we got the long-term debt to equity. We got total debt. What does that tell us? If it's large, it indicates increased financial risk and potential to grow because you're already using that. So that's long-term debt to equity and total debt to assets. How much of the is funded. Then we look at tangible net worth. We'll look at this in fixed assets to net worth. These are the relationships between non-tangible assets and fixed assets, which have a longer lifespan compared to net worth. That measures the debt usage, simply a proportion. The last one is financial leverage, which is total assets divided by total equity. And some of these are just variations on each other, just slightly different ways of looking. But this one will tell you how much of the assets are funded by equity. Okay, so you want to see a reasonable amount in there. What do we know? That if you're using too much, like if that number were 100%, you're probably not taking too much risk. Okay, as a company, you may be able to better leverage the company. At 10%, you're going to find that that may be a company that has a high level of leverage. Okay, so those are the key leverage ratios. Let's keep looking at a couple of them here. When we look at equity ratios, we really want to throw in a couple of pieces. One, dividends, because remember, a company can pay out earnings to shareholders or they can retain them in the company. So we have the dividend yield, which is the dividend the stock pays divided by the price per share. Dividend payout ratio is total dividends divided by net income. So as the ratio of dividend payout goes up, that means they're paying more out to the shareholders than they're retaining for future growth. Now, some more mature companies aren't growing, not at the pace they had been, so they're going to see a higher level of payout. Remember the risk that goes along with that. If a company is paying out 80% of its income to shareholders, if income drops, it can't drop too far before you're going to have to adjust the dividend. So if you have somebody that's paying out 10%, there's a level of safety in that dividend because they'd really have to drop net income before they would touch the dividend. So you tend to look at those companies that have a lower dividend ratio are a little stronger because they have the ability that if income doesn't grow or it declines, that they still will be able to make the dividend payment and retain enough in the company for growth. But the higher that ratio is, it's paying everything out, and there's not going to be much for capital reinvestment, but at the same time, that risk is that you could reduce the dividend. We've seen that with GE in the past couple of years. In fact, it's even questionable whether next year they will pay a dividend. We get into tangible net worth, total equity, less intangible assets. Then we take a look at fixed assets to net worth. Net worth is always referring to is net worth equals net shareholder equity, total shareholder equity, which is common stock, additional paid-in capital, other retained earnings, less treasury stock. So it's that broad category. It measures the extent, really, to which capital is tied up in non-liquid assets. Okay, and it measures the amount of capital remaining more in liquid assets. If there's too much net worth is tied up in fixed assets, you have too little working capital. You've overutilized debt, or profitability suffers. So net worth becomes an important piece. But let's take a moment here and say, what is fixed how does fixed assets affect profits? One, interest expense for funding it. Two, there's depreciation expense. Oftentimes, there's property taxes, if it's a building, insurance cost. When you have fixed assets, you need to insure them. It reduces the amount of working capital that you have. Could result in late charges, inventory stockouts because you don't have enough money to put into working capital. So we have a lot of fixed assets do affect profits. Next one I like to look at is net sales to net worth. And that's really a trading revenue that measures the extent to which a company's sales volume is supported by invested capital. So net sales to net worth. We look at some of the other profitability ratios, and we have 4 of them here. The first 2 relate to the firm's ability to service its debt and its obligations. Okay, so forget, current. It's not about the current. Is the current ratio? Is there enough money to, if we liquidate our current liabilities, to pay off all the debts due in a year? Because the company is on an ongoing basis. But these are the ones that really have a much more important meaning, and obviously the bigger the better. So it's times interest earned, and that's a very simple thing. Is you take income before interest and taxes, EBIT, and you divide that by the total interest expense. If it's small, it indicates that there's insufficient financial solvency, okay? That they're not be able to cover that interest expense. So that becomes much more meaningful. It can be, if it's a high ratio, that gives you strength, okay? So that the more coverage you have of interest, the times interest earned, that coverage for interest, the stronger the company is able to perform. Then, now that's just interest. Then we go to fixed charge coverage. This includes all financial obligations. So that would include not only interest, but principal payments, lease obligations, so we see how many times those are covered. Again, if it's small, it indicates insufficient financial solvency. There's a risk, okay? Then we do return on equity. This is usually measured based on average shareholders' equity, but it's net income divided by equity. It's a return on equity. The higher that is, the better, because that's telling you that they're earning a return on the shareholder's investment. And that has a cost associated with it because an investor needs to cover that, needs to be rewarded for taking the risk with that company. We then have return on assets, and that is net income divided by average assets. How efficiently are they using their assets? Maybe they have too many. When we look at some of the causal ratios, sort of to come back and take another look at that as we try to pull this section together, fixed assets to net worth, do you have an overinvestment? Collection period, if it's going up, that's a rise in accounts receivable. Now, we should see that if sales are going up. But if we see sales remaining flat and a rise in accounts receivable, that could indicate a problem. When we look at net sales to inventory, rise in inventory, net sales to net worth, where are we with our growth? Net profit to net sales, profitability. The last one we can just skip over. When we look at the income statement analysis, let's just end here. Okay, so that takes us through the leverage and starting in on the profitability ratios. So I'm going to take a brief break, walk away, and come back, and we'll finalize this with net income.